how companies raise debt financing to help pay for some of the assets they buy. And remember, there were three different categories that we were going to talk about. One was bank loans. And specifically, we talked about installment loans. Remember, there are a lot of different kinds of bank loans that you can arrange. We talked about installment debt, where you borrow money to make payments over time. We started talking about bonds, when companies need lots more money than they can get from one bank. And there were three different kinds of bond problems you all had to be familiar with. The first one, contract rate, market rate are the same. The second one, zero coupon bonds. The third one, that we're going to talk about in just a minute, is when a company has a bond that has a positive contract rate, but it's different than the market rate. Before we get to that problem, I wanted to show you this page in your packet that illustrates when you talk about bonds and what they're selling for. This is how you quote bond prices. Take a look at that one, for example. That says the bond is selling at 100. And that doesn't mean if you called up your broker and said, buy that bond today, you'd pay $100. Bond prices are quoted as a percentage of their face value. So 100 means 100% of face value. I think I mentioned to you on Tuesday that most corporate bonds have face values of $1,000. So if you call up your broker and said, I want to buy that bond, in addition to brokerage fees, you pay $1,000. There are some bonds out there that sell for less than 100. There's one, I think that says 95. 95% of face value. Why would a bond sell for less than its face value? Why would it sell at a discount? Your mind should be whirling and saying, because the contract rate of that bond is lower than the market rate at the time. That's why it sells at a discount. Or you might have bonds that are selling at a premium. Take a look at any one of these. There's one at 101. It's selling at 101 at face value. Why is it selling at a premium? Because its contract rate is greater than the market rate that day. The reason I brought this to your attention is there's at least one multiple choice question in the test bank that is worded such: if a bond sells at 98, is it selling at a premium, a discount, at par, or none of the above? So you need to be familiar with bond prices are quoted as a percentage of their face value. Now, let's get into this third type of bond problem that you all need to be prepared for. When we were working with zero coupon bonds, one of the things that we asked you all to do was to come up with the issue price or selling price of the zero coupon bond. Same thing with any bond. We might ask you to do that. And what you'll see with any bond, with any financial security like common stock, with any investment at all, including real estate, commodities, and so on, is that they will sell for the present value of their future cash flows. So we first have to identify what the future cash flows are. In this bond, it says it has a $100,000 par or face value, and that the bond will mature in 20 years. So one of the cash flows that you would get if you bought this bond issue is 20 years from now you get $100,000. In addition to that, this is the contract rate. It's saying that you will be paying interest 8% of $100,000 annually. And this is not paying interest twice a year like some of the bonds we looked at earlier. This is going to pay that 8% once a year. So here are the future cash flows. If you buy this bond issue, $8,000 per year and $100,000 at the end of the 20 years. So, what will these bonds sell for? What is their selling or issue price? We have to find the present value of those future cash flows. Now, when we find the present value, very important you don't make this mistake. As the discount rate that you're looking for in the present value tables, do not use the contract rate. Use the yield. Don't use the contract rate for the present value tables. Use the yield. So here I've got $8,000 per year for 20 years. I'm going to look up the present value of an annuity, 20 years, 6%. Turns out to be a little over 11. I've also got 100,000 happening one time, so I'm going to look up in the present value of a dollar table, 20 years, 6%. It's a little over 3. When I add the present value of these two different cash flows, this is telling me how much cash the company will receive when they sell the bonds. Bondholders will be willing to pay $122,939 for those bonds. Any question about that? So again, you can see not only will cash go up, but the company also has a liability of the same amount. $122,939. Now, I've got a quiz question for somebody out there that's worth $4. Be ready. The question is, what do we want that bond payable number to be 20 years from now when the bond matures? What should that number be? Tell us who you are. What should that bond payable number be 20 years from now when the bond comes due? How much should be in the bond payable account 20 years later when the bond comes due?
I don't know.
Okay, that means $6 next time I see you all. Does anybody know the answer to that question? Back in the back? Yeah, we want the bond payable account to equal its face value or par value on the day it comes due. That's how much the company is going to pay 20 years from now. Right now it's 122. We want it to be 100. So what we're going to have to do over the next 20 years is push that number down from 122,939 to 100,000. And the way we're going to do that is each time we calculate interest expense, we're going to adjust the bond payable account. The interest expense, whether it is a bond like this, or a zero coupon bond, or any kind of debt, the interest expense is calculated in this way. You want to take the book value of the debt and multiply it by the interest rate, in this case the yield, the market rate. This is the book value of the bond payable. That's what's on our books as the value of the liability. And so we're going to multiply that by the yield of 6%. Therefore, the interest expense the first year, 122,939 times 6%, that's the interest expense. That's the number that's going to show up on the company's income statement as interest expense. But, as you can see, it's not the same amount that the company actually pays out in cash. Hopefully you all remember, some of the big picture items that we talked about in this course. The very first week that we talked, we were discussing how revenues don't have to be cash inflows and expenses don't have to be cash outflows. Here's an expense. It's not the same thing as how much cash gets paid out to the bondholder. Interest expense is calculated this way. Book value times yield. But the cash of $8,000 is calculated based on two different numbers. Instead of book value, we're going to take par value or face value. And instead of the yield, we're going to take the contract rate. You might remember up here at the top part, how did we get the amount of cash paid out? Contract rate times par or face value. That's the amount of cash the company has contractually agreed to pay out every year for 20 years. So the amount of cash going out is not the same thing as what shows up on the company's income statement as interest expense. Whatever the difference in those two numbers is going to be an adjustment to the bond payable account. And again, you told me just a few minutes ago, we want this bond payable number to eventually go down to 100,000. Therefore, whatever is the difference between interest expense and the cash payment, whatever that number is, we're going to subtract it from the bond payable amount. Any question about that? In the process of doing that for 20 years, we will bring down the bond payable account to its face value of 100 grand. Keep in mind that when we do this next year, this interest expense is not going to be the same number. We're still going to use that 6% yield, but remember, the book value of the debt is no longer $122,939. The book value of the debt is dropped by $624. So since the book value is changing, the interest expense number will change every year. The cash number is going to stay the same. Remember, contractually, we've agreed with the bondholders we are going to pay you $8,000 every year. No questions asked. That's the amount you get. But the interest expense number, which is calculated differently, will change every year. Keep in mind, whatever the difference is between the $8,000 and the interest expense number is going to reduce the bond payable by whatever that amount is. So once again, over 20 years, we are going to reduce the bond payable from $122,939 slowly and surely down to $100,000. Any questions about that? I've told you before, it's very important that when you are learning, you learn conceptually. You don't just try to learn, I can take that problem and I can replicate it. I can memorize it and give it back to you. You have a problem in your homework that is similar to this in the sense that it is a premium bond. Why is this bond a premium bond? Because the contract rate was bigger than the market rate. That's why we ended up with $122,000. But you also have a homework problem that is a discount bond. So let me make up some numbers. Let's say that this is instead of 8%, let's say that's 5%. And the market rate is 6%. Because the contract rate will be lower than market rate, when you go through this process of finding the present value of the cash flows, maybe you end up with a number, and again, I'm making this up, maybe that's $90,000. The bond payable starts out at a discount of $90,000. But what do you want the bond payable account to be 20 years later? $100,000, just like before. You want it to be its face value. But if it starts out at 90 and you want it to go to 100, that means every time you calculate this interest expense and you see the difference between interest expense and cash, whatever that plug figure is, now you're going to add it to the bond payable account because you're trying to force it up to $100,000. Remember, the target of the bond payable account is always its face value. That's where you want to push it towards. If it's a premium bond, you're pushing down. If it's a discount bond, you're pushing it up. So if this was a discount, you would be adding this amount to the bond payable account every year. Any questions about that? So again, you've got 3 different kind of bond problems. This is probably the most challenging. Bonds that have a contract rate equal to the market rate, zero coupon bonds, and these bonds that have a contract rate different than the market rate. Any questions at all? Okay, the third category of debt that we're going to talk about, capital leases. Here you see a balance sheet from Walmart from several years ago. Notice that one of the assets that they list, property under capital leases. Now all these numbers are in millions, so you'll notice here that Walmart has over $3 billion of assets that are under capital leases. They also have, in the liability section, over $3 billion in capital lease obligations or debt. So for a lot of companies, especially retail firms and airlines, a lot of their assets and liabilities are based on or from these capital leases that they are engaged in. What I wanted to point out with this slide is that we're going to be talking about book value again. We're going to talk about it a lot throughout the course. But I want you to remember when you hear that term, it's just a generic term that means value on the books. And so if you hear book value, you have to ask yourself, well, the book value of what? We've talked about the book value of inventory. We've talked about the book value of equipment, or buildings, or land, or zero coupon bonds. And you can see up here, for example, when you talk about the book value of equipment or buildings, it's the original cost minus accumulated depreciation. That is its book value. If we talk about zero coupon bonds, remember we took the book value, the initial sale price, and we added to that every year the interest expense number to make a new book value. And now we're going to be talking about the book value of a capital lease liability. So each time you talk about book value, you can't automatically click in your mind, well, book value means this. Because it depends on what you're talking about. The book value of what? So let's get into a conversation about why capital leases are accounted for the way they are. And I'm going to show you a problem pretty soon to show you how we account for them. But I want you to think about 2 different companies that are identical in every single way. They're in mirror universes. They're